I'm going to be talking to Kevin Birn, who is the chief analyst for Canadian oil markets, S&P Global Commodity Insights, about his company's annual forecast for the Canadian oil sands. A few surprises, as you might imagine, this year. So welcome to the interview, Kevin.
It's nice to be here again.
Now, you and I have done this for a lot of years, and we've talked about the oil sands. You're my kind of go-to economist for oil sands commentary. And this is, I think my take on this is we're seeing some trends that we've been talking about for a while now sort of solidify. So maybe what I'll do is ask you to give us an overview of your update, please.
Sure. So every year, I'd say, I'm going to guess, for over almost a decade, we've been releasing an annual production outlook, much like you've seen from other people in the region. Our outlook has, I'd say, maintained relatively the same shape, although the trajectory has kind of changed over time. What I mean by that is they all have a curve where it would come to a plateau. As the volume would grow, the scale of the industry would grow, and you'd eventually get to a place where you would basically stop growing, and then you end up into a place where you would see something that's mythical in the oil sands, but the declines start to take hold. What we've seen in the most recent update is our current views, and these are all forecasts, Markham, so everybody can have their own view. This is our view, is that we've seen delays in the timing of projects we expected to come forward in the past due to market instabilities. You can think about the regional bottleneck issue causing the differential in 2018. COVID is another major destabilizing factor. It would drain the cash flow and push out the time in which they'd sanction a future project. And then we've also seen the piling on of additional carbon policy and ambition from the producers as well. And as well, when we look forward, a shift in the mentality of investors wanting to see greater returns from the upstream sector in general. These things have had the effect of pushing out the timing of future projects that would come online and then tamping down the number of projects that return to cash flow and the redirection of funds towards decarbonization.
So let's talk about the forecast. When I talked to you in 2019, you were forecasting that oil sands production would grow from 3 million to 3.9 million barrels a day by roughly 2030. Now, and then last year it was 3.6 million. Now it's 3.5 million by 2030. Is that why 3.5 million, and why the almost halving of the increase over the next decade?
So if you think about, and if you go to the actual release, there's a great visual that plots those three, right? So we're very transparent about the outlooks. You can think about that one in 2019, this is pre-COVID, and COVID having the impact of knocking the wind out of everything for 24 months. And then you would slide that graph forward effectively because you have growth occurring later in the outlook. But then our graph, our projection that curves upwards and kind of goes into this plateau is a function of two variables. One is the ramp up of existing installed capacity, which is the bulk of the production forecast, to be honest. And then the back end tail in the latter years is new projects coming in, or not new projects really, but expansions and step outs from existing operations would come in the back half. So because we're measuring at one point in time, which is 10 years out, the effect of delays push that curve out, so you get a lower point in time. And then this new mentality of higher returns to shareholders and redirection of capital to decarbonization knocks a few projects off later in the outlook. And so you end up with a lower point in the 10-year envelope. The other thing is this has happened over period of years. 2019, the difference between 2019 and 2020 is principally COVID. And the difference in the last year is principally a few more projects coming out of the expectation.
Now, there's a couple of variables here that I want to talk about that didn't show up in the press release that I read. One of them is peak oil demand caused by the electrification of transportation. What we're seeing is the automakers go all in on electric, hundreds of billions of dollars committed even just in the next few years to switch to electric. Got to think that 2030ish that's going to affect global demand. But then in the U.S. market, where all of this bitumen is headed, or all bitumen exports are headed, we're also seeing some changes because Mexico has announced that in 2024 it will no longer export 600,000 barrels of Maya heavy, which goes to the U.S. Gulf Coast. How do those trends or those announcements, how do they play into your forecast?
Well, I'd say that one advantage the oil sands does have is that it is locked in on some of the most competitive refining regions in the world. And that's the US Midwest, and particularly the US Gulf Coast. And like you allude to, the US Gulf Coast is configured to processing heavy crude oil. In fact, it's one of the advantages it has is that those refiners have greater flexibility to choose amongst the crudes they want to meet the product they want. And it's an exporter of product that comes out of those refineries as well. And we expect that trend to continue through transition, and the competitors in that region obviously will be impacted as other regions as transition impacts demand for fossil fuels. But the oil sands does supply that in its advantage. And we've seen a tight, heavy oil market. And it's kind of, I don't want to get into the immediate term, but it's been, right now we're seeing strong demand for pretty much all transportation fuels. And we're seeing some weakening of that because of the high prices. But in the longer term, we do think the oil sands is advantage because of that tight relationship with the Gulf Coast, which is configured to process those heavy crudes.
So let's talk about investors, because this is an industry that is not like other forms of oil production. It takes a lot of capital up front. You've made this point many times in previous interviews. A lot of capital up front. Once the capital is paid out, it takes very small amounts of sustaining capital over time to maintain or even to grow production. And investors now have changed they are demanding high returns. And what role do the changing investor demands play? What role does it play in your forecast?
Yeah, I'd say, one of the trends we've seen in upstream E&P generally is a drive by the investors to see greater returns. So you can think about share buybacks, higher dividends, those sense. They want the money, frankly. And that's because of preceding COVID or even through COVID, the sector generally underperformed its peer groups against peer groups. And so we're seeing that pressure, and we're seeing the companies return that cash to shareholders. So yes, they're flush with cash, but it's not necessarily their cash. The investors are like, no, that's mine, and give it to me. That's one impact. So this free cash flow they're generating is being redirected preferentially to the investors. The other thing is investors, we're seeing discount future production more heavily. And so I think this is what you're getting to, is if you believe or see the potential for demand to peak at some future point in the world, you're going to discount future production harder than you would have in the past. And we're seeing this impact longer lead time projects. So projects like deep water offshore, oil sands, and we've seen the oil sands, for that matter, try to collapse that turnaround time, that development time. But the oil sands do have, like you said, larger out-of-pocket upfront expenditures over multiple years before you start generating those returns. That means, how do I feel about oil demand? Well, in the next 3 years, I feel pretty good about it, right? Next 6 years, probably okay. And as you go further out, you're going to start discounting that harder. So if you think about a new mine, it's over 10 years. If you think about a new SAGD facility, like brand new, you're looking 4 to 5 years. And then you can get expansions much shorter cycle. You compare that to tight oil, where people can drill a well fairly quickly, but an actual tight oil program, you're probably looking at 18 plus months. So you think the speed of return is infecting the risk that they put onto these projects, and that's also weighing on the long-term growth outlooks of the oil sands.
What about ambitious Canadian greenhouse gas policy? There's some conflict these days because the federal government has announced an emission reduction plan and a cap on Canadian oil and gas emissions. The oil sands CEOs have been, at least a couple of them have been very vocal in the media, complaining about that, saying that it needs to be put off and so on. But it seems like this is the trend. There's no getting away from it now. Has the industry accepted that it's one way or another, it's going to have to not just bring down its carbon intensity, but also absolute emissions fairly quickly?
I think that's the case. I think we have some debates about the pace and scale between the government and the industry. But the industry has announced through their Net Zero Pathways initiative the intention to reduce emissions by 22 megatons by 2032, which is by all accounts ambitious and somewhat similar to the federal government's ambition for the oil sands specifically, although they have additional ambition across the oil and gas sector for that cap. With respect to the cap that was announced a couple of weeks ago, I think the devil's in the details on the policy choices they make and what those target thresholds they choose are. There is some wiggle room around what current levels means, because it was announced initially in 2019. That was a different level than it is today, than it was in 2020. Even the language, some of the language being presented by ECCC has a little bit of wiggle room of what that looks like as well. And then the policy measures they proposed which is an additive additional cap and trade policy or a change in the pricing mechanism just for oil and gas within the outpost-based allocation process, it would have different implications for the sector as well.
Now, in your report, you talk about how one of the constraints to growth over the long term is the lack of transportation capacity, primarily pipelines. But, you know, I read Premier Jason Kenney's comments to the U.S. Energi committees last month, I guess, where he said that even in the short term, when you bring on Trans Mountain expansion at 525,000 barrels a day, and you have some additional rail capacity, and then you have optimization of existing pipelines, there's, you know, in the relatively short term, there's a million barrels a day of new shipping capacity that the oil sands will mostly be able to take advantage of. Did that get factored into your forecast?
So we actually don't see, well, actually, the best way to say it is, we think they're at presently, based on what's announced and some potential optimizations that have also been alluded to by some of the major pipeline companies and our production forecast, that the system should be able to remain balanced on pipeline for the foreseeable future. Now, should that production outlook change dramatically, or something happen to an existing pipeline were to not continue to be in service, that would obviously change in a pretty quick order. We do feel that in the past, delays and price volatility that's come from those delays of pipelines has affected our outlook, and it is lower than it would have otherwise been as a result, but that's something in the past. So going forward, we think there is adequate pipeline capacity for the system to balance. We do think it will get tight in the mid-2020s, and tight means there's not a lot of cushion or the ability to address upsets should they occur. But right now it does look like, I would agree with what others have said, that the system should be able to balance on pipe for the foreseeable future.
Quick comment, Kevin, and we'll wrap this up, about production costs. You and I have had many conversations about this. The oil sands producers have been very good at driving costs down. What can we expect? Where are we at now on break-evens, and where might the companies be expected to go over the next 5 to 10 years?
So right now we're seeing obviously inflationary pressures on them, and they like us, they pay for the energy they use as well. So that's causing the inflationary pressure. I'd say for the most part, we don't talk operating like you and I talk. I don't usually use operating cost numbers because I include transportation and diluents and those sorts of things. I would say the bulk of the oil sands is still somewhere between the $30 to $40 WTI basis to maintain what they have and continue to produce, and maybe even optimize a little bit, because some of those optimizations are hyper efficient. I think there's going to, where that cost goes, it was going to be depending on the commodity input prices that they use, like you and I use, so the energy prices that prevail in the market. So we could continue to see some inflationary pressure there through the fall, based on what happens to the global gas price and what happens to the oil price. Longer term, I'd expect them to stay in that range, most likely ebbing and flowing based on those commodity prices. But that price, for a lot of people, awareness is at a level that a lot of producers cannot incrementally grow output. And so it is a place where we expect them to be resilient and be able to hang in there and continue to produce through most scenarios.
Kevin, thank you very much. I always appreciate your insights.
It's good to see you again.